Good afternoon, or good morning, or good whatever, wherever you are, everyone, and thank you for joining our panel today. Earlier this year, PIMCO conducted its 14th annual DC consultant survey with 73 consulting and advisory firms in the United States have participated and representing about $5.1 trillion of retirement assets. The survey shows that over 63% of all respondents believe that DC plans should offer a separate retirement income tier. Retirement income tier is one of the, I think, hottest topics in our industry, especially after the passage last year of the Secure Act. With baby boomers being the first generation in the post-war era to retire under a vanishing defined benefit environment, there's an urgent need for a retirement tier in the DC plan to support a lifelong stream of income post-retirement. Today on our panel, we have Jarrott, Heath, a Director of Investments at Comperio Retirement Consulting, and my friend Rick Fulford, PIMCO, Head of Defined Contribution, to dive into this topic with all of you. Comperio is, for full disclosure purposes, is one of the 73 firms that responded to the PIMCO survey. So Jarrott, welcome to today's panel. Let's take a look at what your firm has selected. I'm the one who's in control of these slides, so if it feels a little awkward, I apologize. But we should have all see the first slide. The first slide. Jarrott, if you can take a look at that slide, which really talks about the large plan and small plan comparison advisors and how the selections are in terms of the preferences. Can you talk a little bit about the three highlighted areas that differentiates your firm, and what your thoughts are on those items first, if possible? Let's get started.
Sure, Philip, and to the Spark organizers, thanks for inviting me. It's a privilege. I enjoy being here. A little bit about Comperio before I answer the question, because I think it's important to understand our perspective here. So we are exclusively in the retirement plan business. We don't have any wealth business. We don't do endowments or foundations. We're sort of a one-trick pony, and we like to specialize in what we do. So when we looked at this question, you see some of the other answers up there: improve participant education, evaluate retirement income, and so on. Our answers are shown there in yellow, and ours are different because you sort of look at that list and we think we do all of those things every day. I mean, that's sort of the core of our business. It's what we do. So to come up with a priority, we really picked things that we think have increased in priority this year, or maybe not increased in priority, but certainly increased in focus. And review managed accounts is one. We're seeing a big trend with record keepers and promoting their managed account service. Different reasons why it may be happening more this year than in the past, but we're certainly seeing that. We're seeing it pitched as a service and not necessarily as a fiduciary responsibility. So we have taken it under our wing to educate our plan sponsors on the importance of making that decision, what the fiduciary responsibilities are, how they might go about it. We've established a formal process on evaluating and documenting managed accounts. So that's probably the biggest thing. We've actually we came across one plan sponsor that used to offer a tool to their participants on their platform. It was an asset allocation tool, and within the last 18 months or so, maybe 2 years ago, they took that tool away. It was a free service. They took that tool away and then bundled it with their managed account platform, and then they offered it back. When people asked for it, they offered it back, and it was sort of pitched as, you can have this back, but you need to sign up for this service. And again, we just think it was maybe not as well communicated from our perspective, and everything we're seeing is secondhand, but from our perspective, it wasn't as well communicated as we would have liked. So that pushed that high on the priority list. And
Great.
then, oh, go ahead.
Go ahead. No, great. We'll spend a little bit more time on managed account as how it plays a role or doesn't play a role in the retirement tier in a little bit later. But please carry on.
Oh, sure. The second thing we looked at, or we selected, were evaluate DC OCIO opportunities. And that's where a plan sponsor would essentially outsource the fiduciary responsibilities to an advisor and not sort of be in a co-fiduciary role. And we pushed that up in our focus list for this year because a couple of things. First of all, we're seeing it firsthand, both in the large plan level and in the small plans. So we're predominantly a small plan advisor on an ongoing basis, but we do project work for the $1 billion plus plans and helping them select an advisor. So we'll help them sort through and go through the RFP process and selecting a large account advisor. And in that market, we're seeing advisors pitch their 338 OCIO business as a tool to help plans lower their overall plan costs. Well, everybody wants to lower their overall plan costs, right? So that's pretty intriguing. But when you really dig into what they're doing, we're finding that they're sort of changing out the investments to lower cost, maybe white label products. So they're bringing the investment costs down, but in the end, the advisor costs are ticking higher. And of course, they're justifying that because they're taking on the 338 fiduciary responsibility and the added liability that comes with that. But it's sort of, we think, cynically a way around, or maybe skeptically is a better word, a way around the fee compression issue. And then in the small plan, again, we think it comes down to the fiduciary responsibility, educating the small plan sponsors on what the requirement is. We have an analogy that we use internally. Our founder loves it. I hear it quite often. We describe the fiduciary responsibility similar to giving away the keys to your car. So it's your car, you've given away the keys. If somebody wrecks it, it's not your fault, but it's still your car. So in this case, if somebody does something wrong with your plan, you still suffer the consequences. You still suffer the headline risk. You still suffer with the harmed employees, the harmed participants, possibly lower morale. So we stress, again, the importance of making a good, diligent decision on the fiduciary responsibility there.
Terrific.
And then, go ahead.
Please. No, please. Terrific.
Sure. The last item is setting up the retirement income tier. And I'm not sure we answered this question correctly. This is one of those that I'm not sure we understood the question correctly. If you compare this to the second item on the list, evaluate retirement income. So I think we're looking at tier as more of a plan level decision, as opposed to the second item, retirement income, more of a investment solution or product driven. Again, I'm not sure we answered it correctly, but we've sort of, if you think about it from a plan level, we're essentially implementing it at the plan level. So we are trying to come up with core lineups for the retirement income for the retirees. We're making sure that the plan provisions are established, partial payouts, installment payments, things of that nature. And then working with the plan sponsors to, first of all, see if they're interested in retaining assets. And then second, if they are interested, to what extent are they willing to go to promote it? Are they encouraging it? Are they simply allowing it and sort of indifferent to it? And those are the things that we think about. And for all the reasons that you discussed in your opening, Philip, we certainly agree with what's happening with the trends and in the marketplace and the demographics and why this is so important these days.
Thanks for that. I think to say you are right or wrong, it's too exacting. I think the term retirement tier, which I'm sure Rick has a lot more to add, is not an exact, well-defined term, but it's really very broad. And I think some of the things that you're talking about is very much part of, as I understand, retirement tier discussion. We can narrow it to a individual. We can narrow it to a group of individual or a plan or record keeping or all kinds of things, because there's so many stakeholders in making this thing a reality. And we hope to dive into that a little bit. The next slide talks a little bit about some of your emphasis. I know you are the CIO for Comperio, and you are very thoughtful, or at least I was told, that you are very thoughtful in, in designing core menu, in thinking about long-term investing, which lends ultimately to retirement tier. Can you share with all of us a little bit about your thinking process and by inflation protection?
Sure. So first of all, I think the last sentence on my end blanked out a little. So maybe would you repeat that in case it blanked out for the audience as well?
Yeah. Yes. Please share with us how you think about inflation protection as part of your overall strategy for DC plan core menu and long-term investing.
Sure. So I'm not sure who said I was a thoughtful person. I hate to set the bar too high for the audience, but I'll see what I can do here.
Thank you.
So we look at, certainly inflation is a big concern. I mean, it's always been a big concern, and maybe with bond yields are where they are, the outlook for equities is where it is. Maybe inflation is even a bigger concern. It's hard to, if you look at all the reports that you read, nobody seems to be too concerned about inflation yet. So that's even more of a concern because it's, nobody's pricing it in. So it would be a big shock if it happened. So we look at a few different assets. First of all, to answer the question, we selected REITs, but we don't really select REITs as an inflation hedge. We sort of look at the inflation hedge as a bonus. We look at REITs as just a great diversifying asset, return generating diversifying assets. Normally when you think diversification, you think you're trading something off, you're giving up return to get differentiation. And REITs is maybe one of the better diversifying assets from that perspective and not trading off so much. And then we think inflation protected bonds or inflation linked bonds, TIPS as we call them. It's really the purest strategy. And I know it's not a perfect hedge. It does have some basis risk embedded in there. But of the options that we think are out there, we think that's the most cost-effective and purest hedge. Multi-assets, I think, used to be a great hedge, and I could be wrong with this. Maybe Rick would disagree. Used to be a great inflation hedge, but it's so centered around oil now, and oil has taken on its own supply and demand issues, and it seems to be diverging from what it used to be. And then the one thing that's on here that surprises me is the direct private real estate. As an asset allocator, I love direct real estate for all of the reasons, for the diversification benefit and the return profile. But the liquidity issue we think is a concern. Certainly, our consultants don't want to touch it, and they're the ones in front of the clients the most often. So we think that at the client level, there's a lot of pushback for the liquid investments.
Thanks for your thoughtful response. So it has confirmed that it was thoughtful. Also, we will come back and talk more. The reason we spend this time getting your thought on inflation and so on is really ultimately talking about the retirement tier and how we should be thinking about and how you are thinking about retirement tier. So Rick, thank you for joining our panel today on this important topic. In August, you and your colleagues at PIMCO co-wrote a white paper on building the retirement tier. By the way, for those who want a copy, you can visit the PIMCO booth after this session is over, or go onto PIMCO.com, and you will find your very own copy with your name on it. It is definitely worth a read. In the paper, Rick, you spoke of three powerful retiree preferences. One is to control their assets and retain flexibility. Two, to preserve or grow account balances. And then three, to anchor spending to income received. There's so much there. We're going to spend the rest of this session really dive into it. So let's unpack this a little bit. Rick, what does, we'll take one at a time, to control their asset and retain flexibility mean? And does this have anything to do with a retiree's preference for optionality, one of my favorite terms, vis-a-vis guarantee? I know you have a few slides, so I'm going to advance them as you feel that that's appropriate. That's all right?
Yes, thank you, Philip, and hello from my living room and from PIMCO. It's a pleasure to be here. Before I jump into the optionality question you just asked, Philip, I think it's important to recognize why we think it's important to talk about retiree behaviors, right, and behavioral biases. And the reason is that we're talking about the retirement tier, right? And the retirement tier, by definition, is a self-service menu designed for retirees. And so all of the human behaviors that we've come to know are really important in understanding how DC plans work and how people use them is just as important as it relates to the retirement tier. So we focus on that. But to your question, does control of assets effectively equate to this need for or desire for optionality? I think that's a pretty close correlation. You and I have talked about this before. I also love the term optionality. Look, who doesn't want optionality? Right? Very few people want to be tied into a single path. They want to be able to adapt their life in whatever regard that refers to as things evolve and have the ability to change course. And I think that's very true in retirement as well. A couple things I'll point to that really speak to this this retiree focus on control. If you could, Philip, go to the slide. I guess it would be slide 8.
I can count. Let me see.
There we go. And I'll direct people to look at the right-hand side of that slide as I articulate this. But one of the things that we strongly suspect in the DC world and in retirement in general is that, as people age, certainly as they near and enter retirement, and certainly as their account balances grow and become more meaningful to them than they ever have been, they become more engaged, right? They become more vested in their financial future. And what we think that means is they want to be more hands-on in creating outcomes for themselves. And you can see that on this chart. So look at the blue bars on the chart at the right. This basically shows you target date usage by age. And what you see is that as people progress through the life cycle, they tend to start to opt out of the default, in this case, the target date fund, in pretty meaningful numbers. And that's not to say that target dates aren't an appropriate investment for people along the entire life cycle. That's not the point of this. The point is that people want to be engaged. They want to manage their own assets. And that's really the key, reflecting this desire for control. The other thing I'll point to, if you can go to the next slide, Philip.
Sure.
And I realized we were intending to be talking about the PIMCO consulting survey, which we are, but there's a lot of great surveys out there, and I want to reference some data from one that I found particularly valuable, which is the Ibree, the Employee Benefit Research Institute Retiree Confidence Survey. And if you look at the left-hand side of this page, basically they queried 1,000 retirees, and they said, we're going to give you 2 options for how you would like to generate income in retirement. Option 1 is you manage the assets yourself, right? The portfolio is subject to gains and losses, right? And there's no guarantee of income. Option 2 is you take your assets, you buy effectively an all-in-one solution that guarantees you income for life. Now, what you can see on this chart is that they choose option 1, the manage my own assets option, at a ratio of roughly 4 to 1. So that's really interesting, right? So they seem to be showing a preference for control over guarantees. And then similarly, on the right-hand side, they asked another question that's related, which is, hey, 1,000 retirees, how many of you are interested in purchasing an insurance product at some point in the future that guarantees income? And as you can see, it's maybe 3/4 of the population said they're not interested at all, or they have very little interest. And you may say, well, that's great. So are you saying that people don't like guarantees? And I'm not saying that. It's kind of like optionality. Of course, people like guarantees. But the point is that control appears to be a more dominant factor driving human behavior than this interest in guarantees. And so if guarantees come at the expense of control, if it requires handing over meaningful proportions of your asset balances, if it constrains your spending flexibility, then people tend to say, no, I'd rather self-insure, right? I'll manage my own longevity risk. And so they prefer control and liquidity.
Rick, that's great. I'm going to bring Gareth into this conversation just a little bit. As we think about this trade-off decision between giving up control, what this survey basically says is the on-off switch, complete control or complete no control, which is probably not the case, but for our discussion, let's say that. Jarrott, you have been thoughtful about providing menu design because you are a fiduciary on the plan level. And to take control by a participant, as Rick suggests, some 40-some, 50%, they need to take that decision into their own hands. But likely that decision is also not in their own hands because we know an average investor is not very good in managing money because of behavioral biases and all the other things that we know about. How do you think about it? I know your firm, I don't believe your firm actually give individual participant advice. You are really sitting on the plan sponsor level, if I'm correct. In order for this to not get into a crash, using the car with the key idea, not crash your car, is to really give the proper guidance to pre-retirees or even retirees. How do you think about that from menu design, and then what do you do next? I mean, you are basically relying on somebody else to then take this car and drive it for the participant. Can you talk a little bit about that?
Yeah, it's a good question. It was frankly a question I was afraid you were going to ask. So thank you for.
I won't ask it. Let's move on.
So it's a good question. So I look at investments more from it's a math science. And I don't necessarily consider so much, because you're exactly right. We are at the plan level. I'm not meeting face to face with the participants every day to understand their fears, their wants, their needs. So I'm looking at it more at the as a scientific level at the high level. So I certainly rely on people like Rick to have the creativity, the marketing, the understanding of what plan participants want, what they need. Because I think you can have the best mousetrap in the world, but if the participant doesn't know it exists and they don't understand it, they're not going to buy into it. So I think you have to have an investment or a product that's attractive to the participant. And I certainly agree that a participant is better in a managed product than, generally speaking, than doing it on their own, an investment product. So what we would do from a due diligence or a fiduciary standpoint is to understand the methodology, to understand what Rick's trying to accomplish, and then look at how they execute. And first of all, do we understand and agree with the methodology? And then do we agree that they're executing against that methodology? And if we are, then that would sort of pass the test in my book. I think there are many ways to skin a cat, and I'm certainly interested in how Rick's seeing it.
So since you're so interested in how Rick's seeing it, I'm not going to ask Rick now. I'll ask him later. I would just bring one more point in. I'd like Rick to come back in and talk about his second point. I want to make sure that we have plenty of time to go through all three very important components. But I think one other thing that to link what Rick has shown us clearly here and what you have said is perhaps managed account could play a role with the wonderful products that Rick or others who have created for these distribution purposes or decumulation purposes or lifetime income purposes, with your acumen about science, and put them all together into a managed account that can provide a kind of digital advice or advice necessary to drive the outcome with optionality for one's lifetime. So no response necessary. I just want to put a pin in it, and then we can come back to it if that's okay with both of you. Great. Mm-hmm. Thank you. So let me see. So the second preference is to preserve or grow account balances, Rick. So does this have to do with not outliving a retiree's income or assets and to preserve some for legacy for the next generation? Is that what you had in mind when you put that line in to the white paper?
Yes, it's both of those things, but I think which of those is most relevant really depends on the individual. And let me, before I kind of talk about that, if we can go to the next slide, Philip.
Sure.
And I'll just point folks to some data here, which I think will form a good basis for this conversation. So again, this is from the Ibree Confidence Survey on the left-hand side. Retirees were basically asked, what do they expect to do with their account balances in their retirement years? And what you can see is a full, 85% of the retirees, the 1,000 retirees asked, intend to either keep their balances flat or actually grow them over their retirement years. Only 7% said that they plan to draw down their retirement assets over time. I think this is a really important point, and I think it's one that isn't particularly well or sort of widely believed in the industry, right? I think we often hear, well, of course people have to draw down their account balances if they hope to have a successful retirement. But what retirees are telling us is, no, we don't. And empirically, if you look, at least historically, they tend not to draw down their account balances. But your question is, well, what motivates that? And so, again, it depends. I think for the wealthiest people amongst us that are, fortunate to have that luxury, yes, part of their motivation is is a bequest motive to preserve assets for their heirs. But I don't think that describes the vast majority of the population, certainly not the average defined contribution participant, who I think is much more worried about just having enough assets to last their lifetime. And what drives that, so the reason they don't draw down their balances is because they're worried, right? Because they don't know, they don't know what of their expenses will be over time. They don't know how long they're going to need to pay those expenses because they have no idea how long they're going to live, right? So you take uncertainty around expense level and how long you're going to need to pay those expenses, and I think it makes for a very, very complicated decumulation problem that I think you said up front. Very few people are well suited to solve unless they have an advisor that's telling them exactly how to manage that. And so what you find is that people find a tremendous amount of comfort, and it reduces their anxiety in retirement if they just don't draw down their balances, right? There's always this sense that, okay, well, I'm okay. My balances are what they were. And the flip side of that is they therefore tend to spend only from income or largely from income.
Thanks, Rick. So one of the things that we think about is that when the industry, I don't mean we, the three of us, when the industry talk about income and so on and preservation and legacy and not spending the assets, all that is absolutely true. But I think that you begin to share the segmentation of the population. So if we're talking about the top 10%, it's a very different than the bottom 50%. I think there is no question that as a whole, this country have undersaved, underinvest throughout the years. And so I think that it could be an aspirational goal to go forward for that average participant. I don't mean the highest or the lowest, but the average participant, aspirational goal not to spend down their assets. And I think that's right because of those real or imagined fears, right? But on the other hand, I think the reality bites. Reality is that for many of us who have undersaved, underinvested, and behavioral bias-ridden processes, decision-making, that has really left us but no choice but to spend down. So I think part of this retirement tier, in my thinking, is to be sensitive to those individuals as well, because of course our clients are not just one extreme or the other, and to develop products, develop lineups, develop strategies that is able to help a broader group of participants. Let me turn to you, Jarrott, a little bit. How are your firm thinking about that as you think about the menu, as you think about all the things that we have been talking about?
Yeah, so I think that's a great question, and it's certainly at the forefront of the way I think about it. I don't know that I can speak for everybody in our office, but it's always my question whether we're looking at a retirement income solution or an accumulation, a target date type of solution, is who are you solving for? You mentioned the average participant, and I could even argue that should you solve for the average or should you solve for the median? With many of our clients, it's still a big difference. Yeah. And that's always the challenge, is who are you solving for, and what does that solution look like? And then if you think, what's the likelihood of retaining assets in a plan for the highly comp versus maybe the lower income? And that's, again, where I rely on people like Rick to have a better understanding, people like yourself who are working with individuals to understand what's happening at their level.
Doesn't sound like you do much. You're relying on him and me. What do you do? Okay, we're going to move from that. Sorry, Jarrott. We have a question from the audience. I think it's for Rick. So let me tee it up here. Do you think that the control vis-a-vis guarantee is an educated response? Do these individuals fully understand how the choices impact their retirement? Rick, you want to take a crack at it, and then we all kind of go around and share a little of our thoughts?
Sure. I wouldn't say it's an overly educated response necessarily. The control issue that we're speaking to is really is more of a behavioral bias, right? People don't want to relinquish control, particularly in something as important as retirement, where they feel the consequences of relinquishing that control could be really meaningful to them. So it's very difficult to relinquish that control. I think the other issue, with more, this is more looking at the guarantee side of the equation, is guaranteed solutions and products are, generally speaking, pretty complex. And so I think you find that the average person kind of shies away from really understanding the nuance sufficiently to get comfortable with making that choice, which I think explains why you see such low adoption of these types of solutions on an opt-in basis, right? Where someone's working with an advisor or has personalized advice, and they are helped to understand the value that a guarantee may bring them in certain ways, shapes, and forms. That's an entirely different outcome. But if individuals are left on their own to evaluate, I think they end up going the direction of control over guarantee.
Jarrott, any thought on your part? Agree?
It's more suspicion and intuition than having enough data to believe it to be factual. But I think you would start with a retiree. My experience is personal through my family members that have retired. And the first question is, what kind of shape am I in? I've got this amount of money, and how do I make that last? And once they understand that they have enough to live in the manner that they expect, then they want more optionality, as you guys have discussed. So to me, it goes through a progression on what their status is, and again, their comfort level. I don't know if you told them they had plenty of money and they really didn't. If you're some sort of unscrupulous advisor out there, I don't know that they would know the difference. So that's the big challenge, is I think educating them and getting them to the comfort level, and again, in a realistic fashion.
Sounds like something that all three of us hopefully can agree is that as participants get closer and closer to retirement, they really need good advice. And the problem is affordability in plan. So perhaps we can do some digital advice, and then for those higher end that they can afford to pay for advice. But advice is central, regardless what lineup you have, regardless what product, that wonderful product that PIMCO is creating. It seems to me that is absolutely necessary to help people to cross that bridge onto retirement. Okay. Finally, then, Rick, what about the third response, to anchor spending to income received? sounds like we shouldn't use our credit card and go crazy at the mall or virtual mall. Does this have something to do with the asset longevity? Largely, it's determined by the sequence of market return and spending behavior. I know that's something that you talked about, Rick, in your white paper. We don't suggest that we go tell a client about sequence of market return. I think we'll lose them in 3 seconds. But we are a sophisticated audience here, so please feel free to espouse your thoughts on those two things.
Yeah. So look, empirically it shows that people spend not entirely from income, but largely from income in retirement, and they tend not to draw down their balances. Do I think that's motivated by an understanding of sequence of return risks? No. But it's important, right? I mean, certainly the pattern at which you spend, it has a major impact upon longevity risk. But I think really the reason why people spend predominantly from income is what we talked about previously, which is because they're worried about running out of assets, they try not to draw down their balances. And so by definition, if you're not drawing down your balances, you're largely spending from income. So I think it's just sort of a second order effect of this primary goal of keeping my asset levels relatively steady. But what's interesting about all of that, and we often in the industry talk about how DC participants tend to make poor decisions. In a funny way, they're doing an okay job. If they're spending largely from income, they're doing an okay job of managing sequence and return risks and longevity risks. Whether it's optimal or not, we can all argue that point, but it's probably more good than it is bad. I think the other part of what I hear when you ask that question is the other piece of it is, well, yes, retirees spend from income, but is that a good thing, right? Should we try to get them to do something different? And I'll point you, if I can, Philip, to slide 11. So we did some work on this at PIMCO to sort of try to figure this out. And so bear with me. Basically, think of two retirees. One, and they follow very different spending patterns in retirement. The first is someone that spends almost entirely from income, right? So their experience is, in up markets and the portfolio is doing well, they have a little more income, they spend a little more. In down markets, the portfolio is down, they have a little less income, they spend a little less. What that approach does, which fits very well in the DC context where you have people that are defined by inertia, right? They don't do a lot, they don't change, is it's automatic, right? They don't have to do anything. Their income will come to them in good markets and bad markets with some volatility. The other type of retiree, let's say they spend all of the income, plus they spend some additional principal. They spend a fixed amount of principal every year. Now, their experience in good years is great, right? They have more income and they're spending some capital, and they probably had enough portfolio returns to cover the capital spend, so they're fine. Where this really binds and becomes important, though, is in down markets, particularly severely down markets, right? So if you think about your portfolio being down, and then you're spending a portion of your corpus or your capital, in essence, what you're doing is crystallizing losses. And depending on the magnitude of that, that may impair your portfolio on a forward-looking basis to produce additional returns. And so what this slide that we have up on the page shows is basically a Monte Carlo simulation analysis of those two different outcomes over lots of different environments. And what you find is that an income-based spending approach does in fact extend longevity relative to one that draws down a little bit of principal. In good markets, right, the best outcomes, it doesn't matter. Retirees would have been fine either way. Where it's really important is in these left tail scenarios, right, where a retiree maybe retires into a couple of years of bad equity markets. That's where this really makes a difference. So I don't think retirees are sufficiently educated on sequence of returns risk, but they do seem to be doing an okay job in terms of the choice they're making to spend largely from income.
Great. I think that that floating on the water, as water go down, you spend less. Water go up, you can spend more. Um, it's again something that makes sense for those who have saved, not undersaved, who have invest, not underinvest. So not everybody going to, no matter how much we wish, I wish, but I'm not going to happen for some portion of the population. So yes, so I think we're going to come up almost to the end. So I'm going to ask what I call a devil's advocate question a bit, and to see if where the conversation leads us. So just about every asset manager has come out with their capital market assumption for the next 5 or 10 years. One thing is universal. The future return is going to be maybe much more lower, very good English there, than the past. More recently, there is a lot of talk about the death of the 60-40 portfolio, since the 40% is expected to generate an unacceptable low return. As you know, Rick, the entire Treasury yield curve, after adjusted for inflation, is and has been, negative territory. I'm talking about negative real rates here, real yield here. So to get anything close to a reasonable return pushed by global central bank policies is to get into riskier assets. We all know that, such as stocks. Now, some of the industry folks are suggesting replacing some of the 40% with fixed annuities to offer not only a stable but guaranteed income stream so that the retiree cannot outlive it. With the basic income taken care of, along with Social Security, retirees can then afford to be more aggressive with Jarrott's core lineup remaining in the portfolio, so that the portfolio can have a fighting chance to grow the account balance and preserve legacy for their heirs if indeed that's something that they want to do. What's wrong with this line of thinking? If you would both talk about it, I just throw it out because I know people talk about these things and it would be silly of us to ignore it. Rick, you want to take a crack at it first, and then I'll ask Jarrott.
Sure. Yeah, there's nothing wrong with that discussion. I guess I'd say a couple things. One, annuities are perfectly fine investments, but I think what we've learned is that retirees, if they have to buy them, if they have to opt into them, they're telling us they don't want them for reasons of cost, complexity, loss of control, right? You attribute the factors. And the truth is, despite Treasury yields being the level you described, you can construct a reasonably high quality, higher yielding fixed income portfolio as a substitute for that annuity structure, recognizing that behavior says they don't want to buy those things. So that's one idea. Two, 100% agree that you have to have equities as part of your retirement income solution. The question is how much. Obviously they have higher return expectations than fixed income, so it's important to help retirees meet that objective of maintaining, if not growing, their balances. To the points Jarrott was talking about earlier, it's actually a reasonably good, at least historically, source of inflation protection, and it helps with longevity risk. But you've got to be cognizant of the risk you take, and so there's a trade-off there. And so if I could ask you quickly, Philip, to go to the next slide, I'll just lay out how this is sort of a 30,000-foot view of how we think about retirement income solutions. And they're different than accumulation solutions. The objectives are different. And in our mind, there's two key objectives that have to be balanced. Number one, if retirees want to spend from income, you should have an income orientation. And we believe that at least 50% of the returns, at least, should come from income generation, not capital gains, for reasons of volatility and loss crystallization that we already talked about. And then two, the volatility or the risk of the portfolio, which directly ties to the equity piece, should be reasonable. Now, according to our consulting survey, the consensus amongst consultants is that retirees should be subjected no more than a 10% max drawdown. And so to close out this section, for me at least, if you can go to the last slide, Philip.
Of course.
Here we put those two ideas into practice, and we blend a sort of higher yielding fixed income portfolio with an equity portfolio at different asset mixes on the horizontal axis. And then we measure it against those two objectives. The green bars represent the percent of income or percent of return coming from income. The blue bars represent the percent of returns coming from capital gains. And then that line that sort of swoops up into the right, which is measured on the right axis, is value at risk or downside risk measurement. But in essence, what we find is that a retirement income solution that has, call it somewhere between 20 and 40% equity exposure, satisfies both of those key criteria. At least 50% of the returns from income and a risk level sub a 10% value at risk. When you get above those levels, you start to sacrifice one or the other or both of those objectives. And so we think this is a decent framework for plan sponsors to be thinking about not only how might I build a solution for my plan, but how might I evaluate the universe of sort of innovative options that are coming to marketplace? Like what makes sense?
Great. We have 4 minutes to go, and I would love to have Jarrott chime in for 1.36 minutes so that I can wrap it up. Please, Jarrott, any thoughts on that?
So first of all, I agree with everything that Rick said. Given where we are today, it's awfully difficult to sort of engineer a better outcome. I mean, if the equity returns are low, I can try to make sure that we've got the best equity options, and maybe we look at it different than a normal style box approach, maybe more factor-based to adjust your volatility. But it really is what it is. I think the right answer at our situation is to fix it at the plan design level, to encourage higher savings rates, to increase the escalation, taking advantage of the Secure Act and things like that. So I don't. If there's a magic bullet out there, I'd certainly like to know what that is, but I haven't discovered it yet.
Very quickly then, do you think that the thoughtfulness that Rick have talked about, both from a behavioral finance standpoint, as well as the need to dial in the appropriate type of risk, it's hard to have one single product that says, hey, you're ready to retire, give me your entire $16 million and we'll put in one product and spit out the income. I assume that there needs to be a complexity that is necessary. And so do you think that your role is not only to pick the quote unquote the right core menu, but your role is also to think about how retirees or their advisors going to put that together that makes sense for them?
Absolutely. Yeah, absolutely. That's critical. And that's always an unknown, which is, it's sort of off topic, but that takes us back to the managed account question is if they're not doing it themselves and they're in plan, they must be using some sort of service. So certainly that's important.
And I see the trend, managed account is being more and more discussed, more and more pushed out there. I think the fees are getting lower. So maybe next year when we come back, we have new ideas on how to express ourselves. So we have a little over a minute left. So thank you both for your thoughts and particular thoughtfulness and a wonderful conversation. And thanks for all those who have logged into our session today. And please visit PIMCO booth. There is one other question here that we didn't get to answer. We'd love to answer that at the PIMCO booth. Click on the group chat portion to get your white paper and whatever else that you want to ask. So thank you very much. It's a wonderful time that we spent together, and enjoy your rest of your weekend starting today. And thank you again.
Thank you.
Thank you.